Hi there. As an FVAS advisor, we'll compare company-paid health insurance with personal premiums and examine the UK tax consequences for directors.
At Fairview Accounting Services, we help business owners navigate the precise reality of HMRC regulations. You're staring at a £3,000 medical insurance renewal, and you place your corporate card on the desk. You have a choice: pay this invoice from the business account or pay it out of your personal savings. Many directors assume that running the cost through the business automatically makes it a tax-free corporate expense. This graphic illustrates how HMRC actually treats that payment. While the business claims an allowable expense, a heavy taxable benefit in kind drops onto the other side of the scale. You are trading a direct personal cash payment for administrative complexity. The company gets a deduction, but both you and the business acquire a shared tax liability. Securing that corporation tax relief carries a cost. To know if the strategy actually saves you money in the 2026-27 tax year, you have to calculate the impact against your own personal tax bracket. This waterfall chart compares the company route versus the personal route for a £3,000 private medical insurance premium. The business deducts the full £3,000 from trading profits, reducing the corporation tax bill by up to 25%, saving £750. But creating this benefit generates a secondary tax. The company must pay an employer national insurance charge. At the 15% Class 1A rate, that adds £450 back to the company's cash outlay. Then the liability crosses to you. HMRC adds the $3,000 medical cover to your personal taxable earnings. Writing a personal check avoids the benefit-in-kind friction entirely, but the heavy toll of dividend taxation destroys your overall efficiency. The company route is almost always mathematically cheaper. Exactly how much you save relies on aligning your company's corporation tax rate with your personal income tax bracket. Cautionary: this decision tree flowchart shows how simply paying the bill from the corporate account guarantees nothing. The legal structure of the contract dictates your tax outcome. To remain compliant, the insurance policy must be drawn up explicitly in your limited company's name. If you set up the policy in your personal name and have the company reimburse you, you fall into a severe trap. HMRC categorizes this as the company paying off your discharge of a personal debt, a pecuniary liability. That classification treats the payment as pure cash earnings. It triggers both employee and employer Class 1 national insurance, completely destroying your tax efficiency. The legal signatory on the document controls the entire tax outcome. A single administrative mistake here doubles the total tax burden of your policy. While standard medical insurance is taxable, specific HMRC health provisions are entirely tax-exempt. Since April 2026, companies can reimburse you tax-free for display screen eye tests and lenses. You can also receive one annual health screen and seasonal flu vaccinations without triggering tax liabilities. Unlike standard private medical insurance, these items bypass Class 1A NICs and require zero personal tax adjustments. For your standard taxable medical insurance, the compliance reporting is shifting fast. Traditional annual P11D forms are being phased out. HMRC is officially mandating real-time payrolling for all benefits, starting in April 2027. This forces a severe cash flow impact on your business. Your 15% Class 1A employer NICs will shift from a single annual summer payment to a proportional monthly cash drain. The 2026-27 tax year serves as your final opportunity to either register for voluntary payrolling early or rely on the old P11D system. Utilizing these newly exempt reimbursements is simple. Failing to adapt your payroll software and cash flow expectations for the 2027 mandate will result in costly non-compliance. This quadrant chart maps personal tax bands against company profit levels to answer the ultimate question: who actually wins by routing health insurance through the company? The ideal candidates are higher-rate taxpayers running growing companies that face a 25% corporation tax rate. Here, the 25% corporate tax relief vastly outweighs the 15% employer NICs. It's mathematically superior to personal dividend extraction. The reality changes for basic rate taxpayers, whose company profits sit under £50,000, subjecting them only to the 19% corporation tax rate. The minimal tax savings achieved at these rates rarely justify the administrative burden of processing benefits in kind and adjusting your monthly payroll. Structuring the contract correctly from day one is the only way to secure the benefit and save yourself immense compliance headaches down the line. Every director's tax bracket, dividend extraction strategy, and profit level is entirely unique. This framework serves as general guidance, not rigid law. Before you lock in your financial decisions, consult a qualified professional. Reach out to Fairview Accounting Services, and we'll tailor this strategy to your limited company.